Good morning. The market just broke, driven by a hawkish Fed. Here's the plan for today, November 13th.
All right, let's get right into it. Yesterday was a sharp reversal, and what it did was put the market at a really critical inflection point. To be blunt, the Fed just put that key SPY 670 support level on notice. So what was the driver? Simple. The Fed repriced risk, and the market had no choice but to follow. The main engine here was a major repricing of monetary policy expectations. Okay, look at the numbers. The S&P sold off, down 1.66%. Now, that's the third 1% plus down day we've seen in just the last 2 weeks. That's not noise. That's a clear signal that volatility is picking up. And here's what's really telling: the sheer velocity of this shift. You look at the CME FedWatch tool. Odds for a December rate cut just collapsed. We're talking from 68% down to 49% in one session. That's a huge move in market expectations, and it happened fast. And why did this happen? It was a direct reaction to all that hawkish chatter we've been hearing from multiple Fed officials. They started questioning the need for a near-term cut, and it seems like after weeks of ignoring them, the market is finally being forced to listen. Okay, so that repricing has injected a few new factors that are absolutely going to drive volatility today. Let's dig into how this is affecting the current market structure.
All right, here's the crucial part for today's session. Major indices, think SPY and QQQ, have now flipped into a negative gamma environment. And you know what that means? As prices drop, dealers have to sell futures to hedge, which just accelerates the move down. It's a feedback loop, like pouring gasoline on a fire.
What's making this even trickier is the serious lack of clarity right now. Key data points like CPI and the jobs report, they're delayed because of that recent shutdown. Plus, we've got huge event risk on the horizon, the next FOMC meeting, and of course, NVDA earnings. So the market is basically flying blind right into some major catalysts. So with that backdrop, let's look at the market structure. Where's the money actually moving? This is where we can see the real story. And this chart tells the tale perfectly. There's a clear rotation happening just under the surface. You can see capital flowing out of those mega-cap tech names and into value sectors. Think financials and healthcare. And if you look at the relative strength in the equal weight indices, it just confirms this whole defensive shift. Okay, so all of this brings us to the most important part, the key levels for today. For SPY, the line in the sand is 670 for support. To the upside, resistance is at 674. That's the immediate battleground we're watching. All right, before we get into the scenarios, just our standard reminder. This content is for educational purposes only. It's built from public sources to help you stay informed and sharpen your own decision-making. Always do your own research because this is not financial advice. And just a quick note, if you find this helpful, please subscribe and turn on notifications for our new weekly market update playlist. That way, you won't miss any of the weekly recaps. So given all these factors, let's lay out the primary scenarios for the next 1 to 2 weeks. This is the playbook you'll want to have ready. Our base case, we're looking at volatile chop right around that 670 level. Now, the bull case gets triggered if we see a firm reclaim of 674. On the flip side, a decisive break below 670 is the trigger for the bear case, and that puts the 661 lows in play. It really is a classic showdown at a critical pivot point. All right. Let's boil all this down into the two core arguments, the bull thesis versus the bear thesis. This is where the rubber really meets the road. So the bull thesis goes like this. This is just a necessary, even healthy pullback to a strong area of technical and options-based support. They believe this is just setting the stage for a rebound after the FOMC or NVDA earnings. Basically, bulls are looking for a catalyst to come in and buy this dip. The bear thesis, on the other hand, says that this hawkish Fed shift is for real. They're betting that the negative gamma environment will just pour fuel on the fire once SPY 670 fails, forcing a retest of those recent lows. In short, the bears are smelling blood in the water. Okay, so how could you potentially play these views with defined risk? Let's talk about a couple of potential setups. Time to get tactical. For a bearish setup, you could look at a continuation play on Tesla. The idea would be, if it breaks below its prior day's low, that's around 396.50, then puts or put debit spreads could be a way to express that view. And your invalidation? A reclaim of that level. Simple as that. Now, a serious warning here. Options carry substantial risk. You need to understand that your capital is at risk, and losses can absolutely exceed the premium you paid. Discipline with your position sizing and your stops is critical. This is not a game.
Hey, if this is helping you frame the market, do us a favor and hit like and subscribe. And make sure to turn on alerts for the next morning brief.
So that leaves us with the big question for today's session. We're at a clear inflection point, so what's it going to be? Will the dip buyers step in and defend support here? Or is this Fed repricing going to force a whole new leg down? And one last time, this is not trading advice. It's a market update to keep you informed. All markets carry risk, so trade your own plan, manage your downside, and always verify the data yourself. We'll be back tomorrow.